Hello everyone and welcome back to the sessions on financial management. Now, in the previous introductory class, we have talked about meaning of financial management. Let me just remind you that financial management is a study about two things, right? That is what? Arrangement and utilization of funds. So before I talk any further, let me just remind you that we are discussing something very basics about financial management. So please write up this point in your notebooks, basics of financial management. So when it comes to basics of financial management, the first thing that I want you to recollect is the meaning of financial management. The term financial management refers to a study of arrangement and utilization of funds. So a business entity will have a need to arrange funds and it will also have a need to effectively utilize that fund. That is the core objective of any business when it comes to financial management. So financial management will always have these two very important aspects. Now, if you can just use your simple common sense, you will understand one point, that how does a business actually begin? Any business, small or big, any business will always begin with an idea. So suppose I am an entrepreneur and I have an idea. I have a business idea. I want to convert that idea into reality. What will I do? I will first look into that what kind of business I want to carry out. For example, if you can see, I am into the business of educational services. Now, to carry out this business, I need assets, correct? Without assets, without resources, I will not be able to carry out this business. Right now, I am at my studio recording this class. I need this camera, I need this microphone, I need this lighting system, I need this air conditioning system, I need these premises, furniture, equipments, etc. everything. That means I need various assets. Now these all assets that I have just mentioned, camera, air conditioner, lighting, furniture, all these are classified as fixed assets, correct? So once I have these all equipments, can I just begin my business? I will need one more thing, some more money to handle the payments of day-to-day operations. For example, if there is a delivery of books and I have to pay the delivery charges to the tempo, I must have that much cash available in my pocket, correct? That kind of money that is kept in business for handling day-to-day operations, it is identified as working capital in the business. So when I am starting a new business, I will make a list of various assets I want to acquire, all the fixed assets. Suppose the total amount that I have to invest in fixed assets comes to 10 lakhs. Then I will assess how much working capital do I require. Suppose the amount of working capital that I require is 4 lakhs. So what is the total money that I want to put in my business, not just towards fixed assets, but even towards working capital? So it will be 10 lakhs plus 4 lakhs, that is 14 lakhs, which will be considered as total amount required to be invested in this business. That is towards fixed assets as well as towards working capital. Now, once I have understood that 14 lakhs of money is required to carry out this business, then I will make a plan of how to arrange this money. Then comes the area of financing decision. Then I will arrange money through different sources. Now one thing let me tell you, when you were small children, school going children, you had no problems in life actually. You know why? Suppose you want some money. Where were you approaching if you need some money? You simply go to your parents and ask some money, correct? You have to just tell your parents that why you need that money. You tell them and they will sanction you. They will give you that money, whatever you require. So because there was only one source of arranging funds, you had no trouble. Look at your position now. You are now CA or CMA intermediate students. You have grown up, and now sometimes you have to arrange money for something that you don't want to even tell your parents. So what you will do? You have now various other sources of arranging that money, correct? You can ask your friends, you can ask your office colleagues, you can ask your teacher to lend you some money, okay? And through this different arrangements, you can gather money for yourself. Now here becomes a complex situation because you will have to take a decision. When there was a single source, you don't require a decision, but when there are multiple sources, you require to take a decision. That same thing happens with a company. When a company has a need to arrange funds, in my example given few minutes back, it was 14 lakhs of capital required. To arrange that 14 lakhs of capital, you have multiple sources like equity shares, preference shares, debentures, international funding. You can have, once the business has started, retained earning will become one very important component of your capital. What is meant by retained earnings? The profits that are earned in the business, which are not distributed to the shareholders by way of dividend, those profits are identified as retained earnings. Let me once again remind you what are retained earnings. Retained earnings are very important source of long-term financing, but this is not an external source of financing. This is basically an internal source of funding. How this internal source has arisen? When you are carrying out business activity on a regular basis, you end up generating profits year after year. Some portion of this profit will be given to the owners by way of dividend. Now you would have seen, in case of proprietorship business, what happens? In case of proprietorship business, the proprietor would want to withdraw certain amount of profit what he or she has earned during the year, but not all profits, correct? Because if all profits are withdrawn, what will happen? You will not find growth in your business. So how do you deal in case of a proprietorship business? The initial amount of capital, add a net profit during the year minus drawings during the year. So in case of companies, the profits earned are not added to capital because that capital is typically equity share capital, correct? Profit is not added to that capital, but profit is maintained separately under the head reserves or surplus or even P&L balance. Now from that reserves, you are utilizing some portion of that reserves for distribution of dividends to the shareholders. So this is basically a drawings made by the owners of the company. That is what we formally call as distribution of dividends to the shareholders. When dividends are distributed out of the profits earned, the remainder profit at the end is called retained earnings. Now that much money will be lying as a surplus with the company, which the company can use it on a long-term basis as its own funds, and that is therefore identified as retained earnings as a very important source of internal fundings and of course long-term funding. Now when we have talked about different types of decisions, we have classified the financial decisions into three categories. Financing decisions, that is all about arrangement of funds, then investment decisions, that is about utilization of funds, and lastly dividend decisions. Dividend decision typically would require that out of the profits that you have earned, how much dividend you should distribute to your shareholders. Now just write some few minutes back I have told you that retained earnings are the last remainder portion of the profits which is arrived at after distribution of dividend. So if you decide to pay more amount of dividend, the amount of retained earnings will be less. If you decide to pay lesser amount of dividend, the amount of retained earnings will be more. And if you decide not to distribute any dividend, whatever profits you have earned, those profits will be reflected by way of retained earnings. So most of the times what happens, for a company to take a decision on how much dividend to distribute, it is a very rational decision because it will impact the entire long-term plan of the company. So whatever I am talking, don't bother, I'll give you systematic notes on the same. Don't write anything as of now, just try to listen to me. So we have three typical types of financial decisions: financing decisions, investment decisions, and dividend decisions. Now, depending upon the impact of a decision, how long is an impact of a decision? A decision's impact could be a short period impact like 2 months, 3 months, 6 months. A decision's impact could be long term impact, 2 years, 5 years, 10 years, 15 years, 20 years. How do we differentiate what is long term and what is short term? We draw a line that is 12 months. Anything within period of 12 months is considered as short term. Anything beyond the period of 12 months is considered long term. Now use your simple common sense. Two typical types of decisions under financial management: financing decisions and investment decisions. Financing decisions all about arrangement of funds, investment decisions all about utilization of funds. Now each of these decisions can be further classified into short term and long term. So there may be financing decision classified into short term financing decision or long term financing decisions. Likewise, investment decisions can be classified into short term investment decisions or long term investment decision. Now another point of notice: when you arrange money, when you are taking a financing decision, you end up arranging money by creating a liability, correct? Suppose you have made a short term bank borrowing. What journal entry you will pass? Bank account debit to bank loan account or to bank borrowings account, whatever. So one side you have got money, but other side you have created a liability for yourself. Arrangement of funds will always result into creation of liability or equity. On the other side, when you talk about utilization of funds by acquiring any asset, you are actually making investment. So long term financing decisions and short term financing decisions both will result into equity or liabilities. Now if it is short term financing decision, that means you have arranged funds for a shorter period, it will definitely create a short term liability, and short term liability we generally identify as current liability in the business. Likewise, if you have made any short term investment, the nature of the asset that arise will be a short term asset, and short term assets are basically identified as current assets. For example, if you have invested your money in purchasing stock in trade or purchasing raw material, the period for which you will be holding that stock will be a very short period, maybe 2 months, 3 months, depending upon the operating cycle of the business. So that kind of investment is for short term, and therefore the nature of the asset that arises is also a short term asset. Stock in trade, that is generally called as inventory, cash and bank balance, debtors, bills receivable are all examples of short term assets or current assets. So friends, when there is a short term financing decision, it will create current liability. When there is a short term investment decision, it will create current assets. The study of current assets and current liabilities we will be covering up under a very important topic titled as working capital management, because when we talk about working capital is nothing but the difference between current assets and current liabilities. We will be discussing everything about working capital in details when we land up into that particular topic. So here I am talking too much and not making you write anything, but do not worry. When you start writing the notes systematically, you will understand each and everything. And this is nothing new. In the previous class, I definitely have discussed all these points with you. Now, I have told you different stages of getting started with a business. I have told you how do you classify business decisions or financial decisions into 3 categories. How do you classify decisions into short term and long term. So enough of talks, I guess. Time for you to note down some very important notes over here. So I'm sure all of you have written this heading, that is basics of financial management. And now in this heading, I want you to write these important notes. So based on what we have just discussed, please write under the heading financial management, that is the meaning of financial management. Financial management is a study of arrangement and utilization of funds. For any business enterprise, the three key questions being considered are as below. Number one, where to get the money from, that is typically financing decision. Number two, where to invest the money, that is investment decision. And number three, how much dividend to be distributed to the shareholders, that is dividend decision. There are two basic aspects of financial management, that is procurement of funds and effective utilization of funds to achieve business objectives. Let us move ahead and now deal with a short story over here. Mr. NJ, who is an entrepreneur, this person says, I have a great business idea. I need to transform this idea into reality. I will need various assets. Now obviously when someone has to start a business, that person will need various assets depending upon what kind of business setup someone wants to formulate. So let us begin with different types of asset that this person may require in his business. These assets may be comprising of building, machinery, furniture and maybe other equipments. So now Mr. NJ says, with all these assets I will be able to start, but will this be enough? Now this question, just this much asset, will it be enough? Now think on one thing, you have acquired building, you have acquired machinery, you have acquired furnitures and other equipments, but to run the business, for carrying out day-to-day operations, you need some more money, correct? So make sure that you understand this line, that apart from the fixed assets, the entrepreneur would also need to determine how much working capital will be needed to run the daily operations. Now what could be examples of money needed for carrying out daily operations? You can take example as for payment of raw material, for payment of salaries, wages, etc. That is routine day-to-day expenses, you will need money. That means apart from making investment in these fixed assets, you definitely need some additional money, and that additional money will be considered as working capital. Let us see what is happening over here. So Mr. NJ says, wait, I will also need some money as working capital. So this equation is to be considered as very, very important. That is, total investment required equals to aggregate of two things, that is investment in fixed assets plus working capital. Now let us look into, after all this thing has happened, what Mr. NJ has to say further. He says, now I need to decide how to arrange this required amount through different sources. Now this money can be definitely arranged on a long-term basis. When I say long-term basis, I am talking about long-term sources of funds, and these could be debt or borrowings, these could be preference shares, these could be equity shares, some or the other source, and you have to make a right mix of these different sources. Now you need not write any of these contents. I'll give you this in writing later, but I'm sure you have understood the matter up to this stage. So moving forward, we would say, for the purpose of starting any new business, an entrepreneur goes through the following stages of decision making. Stage 1, decide which assets, that is premises, machinery, equipment, etc. to buy. Stage 2, determine what will be the total investment required for buying these assets. Stage 3, the entrepreneur would also need to determine how much working capital will be required. And you know one thing, the amount as per stage 2 and stage 3, when taken together, you will come to know that it is the total amount of capital that will be required. So obvious stage 4 will be, decide on what all sources need to be considered to finance the total investment and what will be the proportion of each of these sources in the capital. Let us move ahead, and now what we do is we write up aspects of financial management. The aspects of financial management can be classified broadly into two categories. that is procurement of funds and utilization of funds. Let us first talk about procurement of funds. Since funds can be obtained from different sources, therefore their procurement is always considered as a complex problem by entities. Some of the common sources of long-term funds are equity and preference capital, debentures and funding from banks, retained earnings, and international funding. Now, I am sure you understand the meaning of equity and preference capital. You already know what is the meaning of debentures. Funding from banks typically means bank borrowings. Retained earnings, let me explain this point. We have discussed this thing earlier, that when the business is generating profits, the final amount of profit which is even left over after distribution of all dividends, that funds can be retained in the form of capital for the business ahead. For example, if a business has earned net profit of 10 lakhs and out of that 10 lakhs of profit, the business entity or the company has distributed only 2 lakhs as dividend, balance 8 lakhs will be remaining with them as retained earnings. It will be definitely forming part of your long-term capital employed. And yet another source of long-term funds could be international funding, borrowing in foreign currencies, etc. Let us move ahead and continue writing further. You may further write effective utilization of funds as heading. The finance manager is also responsible for effective utilization of funds. He has to point out situations where the funds are being kept idle or where proper use of funds is not being made. Mind it, when you have procured the funds, these funds have been procured at some cost, right? So you cannot afford to keep your money idle. Let us even write that point. All the funds are procured at a certain cost and after entailing a certain amount of risk. If these funds are not utilized in the manner so that they generate an income higher than the cost of procuring them, there is no point in running the business. Hence, it is crucial to employ the funds properly and profitably. Let us move ahead and now we talk about the financial decisions. I have been telling you that financial decisions are broadly categorized into 3 different types: financing decisions, investment decisions, and dividend decisions. Now, financing decisions can be classified into further 2 categories: short-term financing decisions and long-term financing decisions. Similarly, investment decisions can also be classified into 2 categories: short-term investment decisions and long-term investment decisions. Now, short-term investment decisions will be basically resulting into liabilities identified as current liabilities, whereas when we talk about long-term financing decisions, these will be sources of capital and this will be resulting into the capital employed of the company. On the other side, the short-term investment decisions will be resulting into current assets and long-term investment decisions will be basically involving capital budgeting decisions. Let us move ahead and now what we do is we talk about short-term financing decisions and short-term investment decisions. As we have discussed earlier, short-term financing decision will always result into current liabilities and short-term investment decisions will always result into current assets. Now, the entire decision making about current assets and current liabilities is always carried out commonly under one common topic, that is working capital management. Let us move ahead and continue writing further. Long-term financing decisions will involve different subcategories, that is study of leverages, cost of capital, and capital structure decisions. If you are not understanding what is the meaning of leverages, what is the meaning of cost of capital, don't bother about it, because we are going to learn this in detail when the right time comes. So these will be resulting into the long-term capital employed for the company, and long-term investment decisions will typically involve the application of capital budgeting and the process of risk analysis in capital budgeting. Let us move ahead and now I want you to put a heading as income statement. Now, what exactly is income statement? I'll explain to you. But first you write this heading, and under this heading you please take note of this small statement what I am showing over here. I'll explain everything in details. Let me explain this whole thing to you. Income statement will be required at different stages of financial management. So basically, when you talk about financial reporting, that is accounting specifically, income statement basically means profit and loss statement. You start with sales and you arrive at net profit after tax. That is the objective of income statement in financial reporting. But under financial management, income statement can be designed depending upon objectivity. Now this point I want you to clearly keep into your mind, that the purpose of presenting an income statement could be different. It may be that you want to arrive at operating profit. It may be you want to arrive at the taxable profit. It may be that you want to arrive at retained earnings. It may be that you want to arrive at earnings per share. It may be that you want to arrive at the amount of cash flow that the entity is able to generate each year. That means there can be different objectives of presenting an income statement, and accordingly, depending upon the objective, why are you presenting or preparing that income statement, the structure of that income statement will be therefore altered. So don't be rigid when it comes to income statement. Always look into for what reason you are presenting an income statement, and automatically that flow of logic will be there. Therefore, what happens, who will end up struggling over here? People who are just mugging up a format. On the other side, students who are logically understanding the flow of different components of an income statement, they will clearly understand that, oh, fine, that because we have to compute this profit, we will draft our income statement this way. Because we want to compute cash flow, we will draft the income statement this way. Okay, we want to compute operating profit, we will draft it this way. That means always look into the objective. So, basic things which will not change. Let us begin our discussion from here. So, on a simplest understanding, sales minus cost gives you profit. You tell me one thing, isn't this clearly understandable that sales minus cost will give you profit? Now, cost can be classified in varieties of ways. What I am trying to do is, I am trying to just give you different approaches or different bases of classification of cost. Cost can be classified as direct cost and indirect cost. Cost can be classified on the basis of its element like material cost, labor cost, overhead expenses, etc. My concern right now is classifying the cost into two categories based on the behavior of the cost. Now, what do we mean by behavior of the cost? How does a component of cost behave when the volume changes? Cost which will vary with the changes of the volume will be considered as a variable cost. I repeat, cost that will vary with the changes in the volume will be considered as a variable cost. On the other side, cost that does not change with the changes of volume will be considered as fixed cost. Let me give you some examples over here. Can you see this remote control over here in my hand? This remote control is basically made out of plastic and other materials. So the plastic material that is used for this remote control, if I want to produce 1000 units of this product, I will need so much quantity of material. Suppose for each unit I require 100 grams of plastic. So for producing 1000 units, 1000 multiplied by 100 grams of plastic I will need. So that will be what? 100 kilogram of plastic. But if I want to produce 2000 pieces of that, I will proportionately need more plastic. If I want to produce 20,000 pieces of this, I will proportionately need more and more plastic. So the plastic cost, that is the material cost, it will vary with the volume produced. The larger the volume produced, the higher will be that material cost. The lesser the volume produced, lesser will be that material cost. If you don't produce anything at all, you will not incur a single rupee of material cost. I'm sure what I am speaking is making complete sense to you. But just imagine another situation, that to produce these remote controls, we have occupied 8,000 square feet of area where we have constructed our factory building. It is then our owned premises. For owned premises, we don't pay rent. But what if we don't own a building? Then we'll have to pay rent for that building. So let us take a scenario where we have occupied a building, a readily available building we have occupied on rental basis from someone, and we have a contract of rent that every month we will pay rupees 2 lakhs of rent. Now just imagine the person who is the owner of that factory building. Will you convince that person that, see, this month you did not produce any remote controls, so please do not collect rent? Or this month the production of remote control was less, so please take less amount of rent? No. You produce less, you produce more, you don't produce anything, rent will be paid at a defined amount every month, and that becomes by behavior fixed cost. Are you people understanding my point? That becomes what? A fixed cost. So sales will be considered as a first element because that is giving you your inflow. From sales, when you subtract cost, you will get your profit. But this cost we don't want to subtract in one go. We will subtract cost at two different stages. First, we will subtract only and only the variable cost, and then we will subtract fixed cost. First we subtract variable cost, then we subtract fixed cost. Now, I have told you friends that we are discussing cost accounting, management accounting, financial management. These aspects, these are very, very important concepts. These are not rules that you have to just mug up. So you don't have to just consider that, okay, sales, from sales you have to first subtract variable cost just because sir has told us to first subtract variable cost. Sir is not setting rules. What sir is trying to tell you is understand the simple concept. Let me give you another example. Can you all see a red color pen in my hand? Let us do a smaller business now. Let us not produce remote controls. Let us become dealer of this pen. Dealer of this pen. Okay. Now suppose I have a small office where I am carrying out my business, small shop you can say, and I have acquired that premises on rental basis. The rent every month is rupees 10,000. Rent every month is rupees 10,000. So how much will be the rental for the entire year? It will be 10,000 multiplied by 12 months, that is 1,20,000. Let us first identify the behavior of this rental cost. Now my business is purchasing and selling this kind of pen. Okay, purchasing and selling this kind of pen. You tell me that if I sell less number of pens or more number of pens, can we agree that the rent that I have to pay is a fixed amount of cost? The rent that I have to pay is a fixed amount of cost. As a result, when I say rent is a fixed amount of cost, means annually 1,20,000 will be the rent paid irrespective of whether I sell any pen or not. Can we agree on that? That every year 1,20,000 will be the minimum amount I have to pay, and that will be the maximum amount, that's a fixed amount. Now, assume that in the first year of operation, I have paid rent of 1,20,000, but I did not sell a single pen. I had made simply no sales at all during the year. The entire year went in planning. No operations actually carried out. Do you know what will happen? The business will not be able to generate any income, but I will have no purchase cost incurred for this pen, no sales revenue generated, but you know, from my pocket I'll have to still pay rent. And how much will be that rent? 1,20,000. Can we agree that I will suffer with a loss of 1,20,000? Can we agree that I will suffer with a loss of 1,20,000? If I am suffering with that loss of 1,20,000, I don't want to incur that loss. So what should I do? I should generate some income to bear the burden of this fixed cost. Such income is called contribution. So if you are wondering what is this term contribution, let me explain it again. Assume that each of these pens I am purchasing for rupees 20 and I have agreed to sell it for rupees 25. Purchase price or cost price rupees 20, selling price rupees 25. Do you know one thing? During school days, your mathematics teacher would have taught you small maths questions that purchase price or cost price of pen is 20 and sale price of that pen is rupees 25. How much is the profit? Like small kids, you would write a statement: selling price of pen rupees 25 less cost per unit of pen rupees 20, profit per unit rupees 5. 5 marks out of 5 marks given to you. But that time you were school going kids. You are now grown ups, correct? You understand one thing, that boss, I have a heavy burden of that rent on me. 1,20,000 of rent I have to pay. Therefore, from sale of rupees 25, if I subtract the cost of this pen, that is rupees 20, rupees 5 is not my profit because I have yet to bear that 1,20,000 of burden. That 5 rupees is basically a contribution for me. So every pen I sell, it is contributing to my business an amount of rupees 5. Every pen that I sell is contributing to my business an amount of rupees 5. Now tell me, during the year, if I have sold 40,000 pens, each pen contributes rupees 5. If I have sold 40,000 pens, let us check by calculator. 40,000 pens multiplied by contribution per unit of rupees 5, it will give me a total contribution of 2 lakhs. But my fixed cost is how much? 1,20,000. With that contribution of 2 lakhs, I will easily lift the load of fixed cost. And after subtracting fixed cost, what will be my profit? Tell me. 2 lakhs minus fixed cost of 1,20,000. My fixed cost subtracted from contribution, the result will be profit, and the amount of profit will be 80,000. Correct? 2 lakhs minus 1,20,000, 80,000. Now, I am not setting rules over here that we should first subtract variable cost and then only we should subtract fixed cost. I am going by simple logic. Every time you sell a pen, there is a variability in two things: the sales that you obtain and the variable cost that you incur, the cost of the pen that you are incurring. Both of these are purely variable elements. So, sale is a variable nature, correct? The higher the volume of the pen that you sell, the higher will be your sales revenue. That means sales itself is a variable element. The higher the amount of pen that you sell, the higher will be the cost of purchase of that pen, because purchase cost will also vary with the volume. Because both of them are of similar nature, with sales we don't associate fixed cost first. With sales we will obviously associate what? Variable cost. So sales minus variable cost will give you contribution, and contribution minus fixed cost will give you profit. Is this much clear to you? So my point is, sales minus variable cost giving you contribution. Contribution minus fixed cost will give you profit. Now, profit also will be having different meanings when it comes to financial management. It could be operating profit, it could be pre-tax profit, it could be post-tax profit, it could be EBITDA, EBITDA. Let me explain you different types of profit and how to land up at each of these profits. So, for this purpose, we need to now further analyze the fixed cost. Fixed cost will first be now classified into operating fixed cost and non-operating fixed cost. You follow what I said? Fixed cost should be classified into operating fixed cost and non-operating fixed cost. Now these concepts actually you will be learning in cost accounting, cost and management accounting subject, but because it is directly involved over here what I am discussing, I am giving you briefing of the same. So I repeat, fixed costs will primarily be classified into two segments: operating fixed cost and non-operating fixed cost. Now, there is only one component of fixed cost which is non-operating by nature. Only one component of fixed cost. All other fixed costs are operating fixed costs. So you just have to understand which one is that non-operating fixed cost. Once you understand, then all other fixed costs are operating. Now, when an entity is borrowing money on a long-term basis, so long-term finance has been arranged through borrowings, do you agree that the entity will have to pay interest on those borrowings? The entity will have to pay interest on those borrowings. So what will happen, tell me? Interest is considered as a financing cost and therefore it is not an operating cost. Interest is a fixed cost. Why? You produce less number of remote controls or more number of remote controls, whatever money you have borrowed, you have to pay definite amount of interest on that. You sell less number of pens or more number of pens, interest, whatever you have committed, that much interest you will have to pay, because interest is dependent upon the money that you have borrowed, not upon the number of pens that you are selling, not upon the number of remote controls that you are producing. Making sense whatever I am saying? So first of all, understand that interest is a fixed cost, but interest cost does not arise because of your operations. Interest cost arises because of a financing activity which is considered as borrowings. So when you borrow money, then you incur interest cost. Now, you understand one thing now, that fixed cost can be classified into two categories: operating fixed cost and non-operating fixed cost. So which is the one element of cost which is non-operating fixed cost? Interest. All other fixed costs are operating fixed cost. Are we clear with that? So we classify fixed cost into two categories: non-operating fixed cost, indicating interest cost because it is a financing cost, and operating fixed cost, all other. Now operating fixed cost we further divide into two categories: cash operating fixed cost and non-cash operating fixed cost. Operating fixed cost we are dividing into two categories: cash and non-cash. Let me give you an example. Rent I have to pay every month, so it's a cash operating fixed cost. I have to pay salaries every month, fixed amount of cost, operating cost, and it is involving a cash outflow. So what will be the journal entry when you pay rent? Rent account debit to cash or bank account. When you pay salaries, salaries account debit to cash or bank account. When you pay insurance premium debit to cash or bank account. When you pay administrative charges debit to cash or bank account. Now, what journal entry do you pass when you charge depreciation on fixed assets? You pass a journal entry, depreciation account debit to cash or bank. Do you ever do that? Do you pay for depreciation? The answer is no. You don't pay for depreciation. Depreciation is a charge that is arising because of reduction in the value of your fixed assets. So if it is depreciation on building, the journal entry will be depreciation charges debit to building account. If it is depreciation on machinery, it will be depreciation charges debit to machinery. If it is depreciation on computer systems, depreciation charges debit to computer systems. Basically, it is not involving a cash outflow. Have you ever thought of assets which are intangible assets? Do you even know what are intangible assets? For example, if I am talking about this calculator, this is my asset. What do you think? Is this calculator a tangible asset or an intangible asset? It is a tangible asset because it has a physical form. It has a physical substance. Depreciation arises because of wear and tear. So depreciation is such a component of cost which is arising because of wear and tear. If there is a physical form of an asset, then the wear and tear will arise. But imagine what will happen with intangible assets. Intangible assets are assets that do not have any physical substance. For example, I own a recording software. I own some kind of softwares through which I create animations. These softwares are not having any physical substance, right? They are just computer programs and they are installed in the computer system. These are basically softwares and these are considered as intangible assets. I have incurred cost towards these intangible assets also, correct? Now, logically, these intangible assets will also be depreciated over a period of time, but depreciation is not the right word that can be used for these intangible assets. Why? Because depreciation word is defined as a charge arising because of wear and tear of assets. Some assets which do not have physical form, the word depreciation doesn't suit over there. Conceptually, an intangible asset is also a fixed asset having a limited life, so it will be depreciated over a period of time. But the word depreciation doesn't suit an intangible asset. Therefore, we have another formal accounting term used as amortization. So, where depreciation is a charge on tangible fixed assets, amortization will be an annual charge on intangible fixed assets. So, if you are charging that amortization on an intangible asset, what will be the journal entry? Amortization charges debit to intangible asset. Point is, it is again a non-cash expense because there is no cash outflow. All other fixed costs are cash fixed cost, but depreciation and amortization are the only two such fixed costs which are non-cash fixed cost. That means if you again go back to the categorization of fixed cost, the way we discussed, fixed cost can broadly be classified into non-operating fixed cost including interest and all other fixed cost as operating fixed cost. Then splitting operating fixed cost into two components, non-cash fixed cost two components, depreciation and amortization. All other operating fixed costs are cash operating fixed costs. So if I from entire amount of fixed cost, if I subtract or if I remove interest, depreciation and amortization, I will call the remaining amount of fixed cost as cash operating fixed cost. It is cash operating fixed cost. I want you to concentrate on this point and very clearly understand that kind of fixed cost will be cash operating fixed cost. Which three elements are not included there in that fixed cost? Interest, depreciation and amortization. Therefore, from the amount of contribution given over here, from the amount of contribution, when you subtract cash operating fixed cost, means you are trying to subtract fixed cost other than three components. You are not subtracting depreciation, you are not subtracting amortization, you are not subtracting interest. So the profit that you get is known as EBITDA. EBITDA. The full form of EBITDA is earnings before interest, tax, depreciation and amortization. Don't worry, I'll make you write that full form also. Just keep listening to me. Earnings before interest, tax, depreciation and amortization. See, it is so logical. When we say cash operating fixed cost, means non-cash components are not included there and non-operating components are also not included there. So what is not included in that fixed cost that we are subtracting? Interest is not included, depreciation is not included, amortization is not included, but all other fixed costs we have subtracted. So we will land up at a profit which is called earnings before interest, tax, depreciation and amortization. Making sense? EBITDA, EBITDA. Now from EBITDA, if I subtract depreciation and amortization, from EBITDA, if I subtract depreciation and amortization, what do I get? Tell me, what do I get? From EBITDA, if I subtract depreciation and amortization, I will be getting EBIT. So from EBITDA, I have subtracted depreciation and amortization, means D and A also subtracted. What remains is EBIT, earnings before interest and tax. Earnings before interest and tax. Now tell me one thing. This earnings before interest and tax is considered as operating profit of a business. Earnings before interest and tax is called operating profit of a business, because whether it is cash fixed cost or non-cash fixed cost, all operating expenses you have subtracted, but non-operating components like interest and tax you have not subtracted. As a result, the profit that you find as a result over here will be earnings before interest and tax. So I have just attempted to explain you this entire income statement up to this stage, and I believe that you are clear with this whole thing and you don't have any troubles. Alright friends, once you have clearly understood this portion of income statement and you have already taken note of the same, let us move ahead and take it further. Last component in that previous statement was operating profit, that is EBIT. Now this EBIT becomes our starting point in this portion of the statement. From operating profit, that is earnings before interest and tax. EBIT stands for earnings before interest and tax. We need to arrive at taxable profit, correct? We need to arrive at taxable profit. But when you talk about taxable profit under income tax law agrees that if you have paid interest, it is your expense. You subtract that interest and then whatever profit you have, on that we will charge tax. So suppose you have earned an operating profit of 20 lakhs and the amount of interest that you have to pay is 4 lakhs. So operating profit is 20 lakhs, interest is 4 lakhs. So your taxable profit will be 20 lakhs minus 4 lakhs, that is 16 lakhs. Tax will not be charged on your operating profit, tax will be charged on taxable profit, and taxable profit, to arrive at taxable profit, interest is an allowed expense under income tax law. As a result, from operating profit you first subtract interest, you arrive at profit before tax or earnings before tax. That earnings before tax will be considered as taxable profit, on that you will charge tax. Correct? So let me bring you back to the statement. From operating profit you will first subtract interest and you will arrive at EBT. From EBIT, if you are subtracting interest, you arrive at EBT. EBT stands for earnings before tax. This is the taxable profit. From taxable profit or from earnings before tax, you now subtract tax, and what you get is the net amount of profit after tax, PAT, standing for profit after tax. Now tell me friends, profit after tax is available for the owners of the company. Who are the owners of the company? The shareholders. Over here you should know one thing, that there are two categories of shareholders: preference shareholders and equity shareholders. So who has the first right to receive dividend? That is, when the profits are earned in the company, who will participate in the profit on priority? The answer is preference shares. That is why they are called preference shares, because they will have the preference when it comes to distribution of dividend. So first right will be of the preference shareholders. But do you know one thing? There is one limitation for preference shareholders. They will be given a defined rate of dividend. For example, if it is 8% preference shares and the amount of preference share capital is 10 lakhs, 8% of 10 lakhs, that is 80,000, will be given to them as their share of dividend. Whatever profits company earn, they will be given dividend of what? 80,000 only. However, this is not like interest, because it is not a cost. Dividend and interest are two different things. Interest, when you say, you have to pay interest whether you earn profit or not. But dividend is basically distribution of profit. You have to pay dividend only and only when you earn profit. So the first right for receiving dividend will be of the preference shares, and then the next right will be for the equity shares. So from preference shares, you are expecting that they will be having the first participation in the profit, but limited participation in the profit. Therefore, from the amount of the net profit after tax, that is PAT, you will first subtract preference dividend, and then whatever you get will be earnings available to equity shareholders. So basically, profit after tax is the total amount of earnings available to all the shareholders. If you subtract preference dividend, you will be getting the earnings available to equity shareholders. Those earnings are the earnings for the real owners of the company, that we call as equity shareholders. So let me just put that focus back on the statement. So from profit after tax, you will first subtract preference dividend, and what you get is EAT ESH. The full form of these abbreviations I will be showing you in a while, but first, when you are writing, it is to be known that EAT-ESH, this term represents earnings available to equity shareholders, earnings available to equity shareholders, and these earnings, when you divide by number of equity shares, you will be getting the earnings available to equity shares on a per share basis, which is called EPS, that is earnings per share. Let us move ahead and now write the full form of these abbreviations. EBIT stands for earnings before interest and tax. EBITDA stands for earnings before interest, tax, depreciation and amortization. EBT stands for earnings before tax. PAT stands for profit after tax. EATESH, that stands for earnings available to equity shareholders. EPS stands for earnings per share. And one more thing that I want to convey over here, see, in the last part, what did you see? That the earnings available to equity shareholders, if those earnings are divided by number of equity shares, you will be getting earnings per share. However, an alternate mode of presenting your income statement could be, out of the total earnings which is available to equity shareholders, definitely you will give some portion as dividend. For example, earnings available to equity shareholders, it is 10 lakhs, and you have given dividends of 4 lakhs to equity shareholders. So 10 lakhs as earnings available to equity shareholders minus 4 lakhs of equity dividend, what you get is retained earnings of 6 lakhs. So let us even write up that segment of income statement. So earnings available to equity shareholders less equity dividend, and what you get is retained earnings.